Hello everyone, and welcome back to our channel Time. Today we're diving into the latest insights from Vince Lanci on why now is a crucial moment for gold and silver buyers. If you're considering investing in precious metals, this is something you need to hear. Let's find out.
On a daily basis, gold is overbought. The market is rallying, but gold is overbought, so it's more vulnerable. On a weekly basis, gold is just getting started on its rally, according to a volatility indicator that I use. And on a monthly basis, it's about a third of the way through a bull run. So maybe another 6 months, according to that. The banks are all very bullish on gold. The press is picking up on gold. And so you should be careful, always. But we are headed into the time of year when we have an election. So we have some conflicting information out there, but the gold bull market rallies on a wall of worry.
The gold market has shown remarkable bullish momentum, with prices recently surging past the psychologically significant $2,500 level. On Monday, the precious metal rallied once again, signaling potential for further gains. This upward trend is driven by a combination of factors, indicating a strong long-term outlook for gold. Vince Lanci, a veteran commodities trader and respected analyst in the precious metals sector, offers a nuanced view on gold's current position. According to Lanci, while gold appears overbought and potentially vulnerable on a daily basis, the weekly chart suggests that the rally is just beginning. From a monthly perspective, Lanci believes that gold is only about 1/3 of the way through its bull run, with potentially another 6 months of upward movement ahead. This analysis aligns with recent observations from Eros, a leading precious metals firm. In their latest report, Eros highlighted the correlation between rising gold prices and increasing expectations for interest rate cuts. They noted that gold recently achieved a new all-time high of $2,531 per ounce, maintaining its position above the $2,500 mark. Eros emphasizes that investor sentiment and interest rate speculation are critical drivers of gold's current performance. The report also indicates that managed money investors have amassed one of the most significant net long positions since the COVID-induced rally 4 years ago, totaling approximately 22 million ounces. Despite the overall bullish sentiment shared by banks and the financial press, Lanci advises caution. His prudent approach reflects the complex nature of the gold market, where multiple factors can influence price movements. Lanci characterizes the current gold bull market as climbing a wall of worry. For more insights from Vince Lanci's expert analysis, don't forget to subscribe and turn on notifications to stay updated. Thanks for watching and enjoy the video.
Now, as to the chart that you're looking at, you'll notice that the bank market-making positions mirror the speculative fund positions. That is not a comment on the banks, that's a comment on the funds. The funds are bullish. They have to buy from someone. They buy from liquidity providers. And in the metals market, liquidity providers are bullion banks because they are the cartel. They have created a cartel over years. The market is not diverse. If you look at other markets, you will see similar patterns. In a market that's speculatively bearish, let's say oil sometimes, you will see the dealers or market makers be constantly long. That would be your citadels, right? But it doesn't show up on this report because it's a more diverse list. So the precious metals market is essentially a cartel that deals with the bulls and bears in the market. The gold market is historically constantly bullish for the reason that gold exists, and therefore the banks must sell to them morally and sometimes legally. And their edge, aside from the information, is in the information that they have and the fact that they have more money than the speculators. Now, the reason that they're having a hard time right now, in my opinion, is because the speculators aren't really speculating. They're physical players who want the gold. And because they want the gold, well, they have pockets that are deep, if not deeper, than the banks. The banks will get out of their positions. The question is at what price? And it's usually when the funds get out of their position. Moving on. Data on deck. Heavy data week. I don't know what to focus on, but I'll tell you what not to focus on. Do not focus on the Fed speakers, okay? Take my thinking cap off. Focus on PCE on Friday. Focus on durable goods today. Focus on home sales on Thursday. That's it. Let's take a look at the charts. We covered the gold charts very extensively, and I'll just say this in summary. On a daily basis, gold is overbought. The market is rallying, but gold is overbought, so it's more vulnerable. On a weekly basis, gold is just getting started on its rally, according to a volatility indicator that I use. And on a monthly basis, it's about a third of the way through a bull run. So maybe another 6 months, according to that. The banks are all very bullish on gold. The press is picking up on gold. And so you should be careful, always. But we are headed into the time of year when we have an election. So we have some conflicting information out there, but the gold bull market rallies on a wall of worry.
Federal Reserve Chair Jerome Powell has laid the groundwork for upcoming interest rate cuts, signaling a potential shift in the central bank's monetary policy. In his much-anticipated speech at the Fed's annual Jackson Hole Symposium, Powell acknowledged that it's time for policy adjustments, indicating a departure from the recent tightening cycle. Although he did not specify exact timelines or the extent of the cuts, Powell emphasized that future decisions would be data-dependent. The direction is clear, Powell stated, noting that the timing and pace of rate cuts will hinge on incoming data, evolving economic outlooks, and the balance of risks. Vince Lanci interprets Powell's remarks as making a September rate cut almost certain. However, Lanci points out that the key questions now concern the pace and size of these cuts. The market is debating whether a 25 basis point reduction or a more aggressive 50 basis point cut will be needed. The current expectation is for the rate-cutting cycle to begin in September, a sentiment supported by recently released minutes from the July Federal Open Market Committee meeting, which revealed that most officials anticipate a September cut, assuming no unexpected data changes. Let's get back to the interview.
Gold experienced volatility at first, but ended the week very strong, while oil extended the week lower as geopolitical risk premiums diminished. Geopolitical risks didn't diminish. Geopolitical risk premiums diminished. Last night, overnight, trading showed mixed price action, with Hong Kong bouncing back after a weaker close on Friday. Expect a quieter session in Europe today, which we're in the middle of right now. Due to the UK bank holiday, gold and oil are both higher now, however, with a firmer dollar simultaneously, suggesting a return or an exaggeration of Middle East nervousness. The week ahead in context of Friday's speech or event, there was some debate on whether Powell could outdove the market, especially considering the S&P had rallied in 9 of the previous 11 sessions and was nearing the all-time high reached just a month ago. However, initial market reaction was positive. Friday's market reaction was positive, with equities buoyed by Powell's recognition of the unmistakable cooling in the labor market. It's uncertain if this speech will be enough to drive markets higher this week. A September rate cut seems certain now, but the key question is the pace and size of future cuts. In summary, now that we have figured out that Powell is almost definitely going to cut, the market has to ask itself, will it rally because of that, or has it rallied too much? And will 25 basis points be enough, or will the forever greedy stock market need 50 basis points? Essentially, while Powell's comments were dovish, they shifted attention to upcoming jobs reports, making the next non-farm payrolls print critical. I think if you look at that, you'll see that if the non-farm payrolls is normal, then it's 25 basis points. If the non-farm payrolls is very weak, the market will start to expect 50 basis points. I'm not so sure they will get it, but that's what the market will expect. On Friday, the nature of the stock market, as well as the gold market move, suggested a low quality rally. Now, obviously it doesn't look that way today. Suggested to make a low quality rally with shorts outperforming in stocks, indicating that further data might be needed to gain fundamental backing in the stock market. Looking ahead, the next 2 weeks will be slightly disrupted. UK is off today and the US is off next Monday. So this week, The focus on the equity side will be NVIDIA's numbers, and they will be on Wednesday.
The upcoming months are set to be intriguing for both the gold market and broader economic indicators, potentially paving the way for significant market movements across various asset classes. How do you think the interaction between gold prices and potential interest rate cuts will play out in the months ahead? If you found this video insightful, share your thoughts in the comments. Don't forget to subscribe to our channel and hit the notification bell to stay updated. Thank you for being part of our community.